Good day, everybody. My name is Paul Spirgel. You're in the Week Ahead in Forex Trading, Not Just Data webinar presented by FX Street with Forexfolio. We attempt to look at the data and news coming up in this week and try to put a little market sentiment spin on it in order to better enable us to make some profits in the market. Before we get started, we have a little legal work to take care of. Our disclaimer. Foreign exchange trading carries a high level of risk that may not be suitable for all investors. Leverage creates additional risk and loss exposure. Before you decide to trade foreign exchange, carefully consider your investment objectives, experience level, and risk tolerance. You could lose some or all of your initial investment. Do not invest money that you cannot afford to lose. Educate yourself on the risk associated with foreign exchange trading and seek advice from an independent financial or tax advisor if you have any questions. Any news, opinions, research, data, or other information contained within this presentation are provided as general market commentary and do not constitute investment advice. Forexfolio expressly disclaims any liability for any lost principal or profits without limitation, which may arise directly or indirectly from the use of or reliance on such information. All right, that out of the way, let's take a little look back at what happened last week. We had some key events last week. We had some interest rate announcements that all went off unchanged. The markets are not looking forward to any real interest rate movements in the future, either on the upside or the downside. As I'm sure you're well aware, over the last couple of months, national and supranational entities, be it the independent central banks or the ECB-like or other IMF-type agencies around the world, have been flooding the markets with liquidity. So for now, it appears that there's enough liquidity in the market. It's just a question of whether that liquidity will reach the right places. So interest rate policy is pretty much on hold across the board. Again, if we get a further deterioration in the economic climate, we'll probably see some other moves. But for now, the rate announcement that we had last week and even a few announcements that we have coming up this week should have no meaningful effect on the currency market. We had a big number last week in the U.S. Non-farm payrolls came out. It came in as expected. We're inching slowly lower in terms of the number of unemployed in the U.S., and that's putting a lift in U.S. markets, and it's giving some positive sentiment to the dollar in general. The feeling in the market is now that the U.S. is going to take a leadership role in terms of recovery and expansion on a global basis. So we're seeing a little shift out of Asia to the U.S. on that, but that bears watching as we get more data coming out in the next couple of weeks. We also had the other big news, which would have been bigger if it had happened when we first started talking about it a month and a half or 2 months ago. The Greek PSI decision came in, and the Greeks were able to get 95.6% acceptance of the refinancing package, if you want to call it that. What the Greeks actually did is they pretty much put on these collective action clauses, which pretty much said you have no choice but to tender. So that's why we got such a high approval rating. Of greater significance in this whole Greek tragedy is the ISDA, which is the Swap Dealers Association. They're the people that monitor and maintain the rules and regulations and all the counterparties for derivatives, interest rate swaps, and CDSs in general. The ISDA came out with a ruling that CDSs will be made to be paid off on. That being said, they considered it a credit event, and the fact that the Greeks told bondholders that they had to accept is very significant for the CDS market, in that the market was beginning to think that because it was a cram down, that the market would not make themselves. It's pretty much the ISDA is run by a bunch of, the bankers themselves. So they didn't think they would make them pay off on these credit default swaps because it wasn't a true default. But they said that it is a default, and they are going to make the people who wrote the insurance, which is what credit derivative swaps are, pay off on the difference between what the bondholders will receive in the Greek debt and 100%. So I believe it went off at about 45. So it's not a complete loss for the people who wrote the CDS, because they are getting some relief in that they are being the bonds aren't being tendered at 0; they're being tendered at 45. So it's actually it shows that this market is growing, and it's a little more mature than it was in 2008 when it had its initial catastrophic event in the U.S. mortgage-backed security market, where everybody was paid off at 100%, and it seemed like the market really just did not know what it was doing. But so it's good for that. But again, Greece itself is a relatively small problem, so the fact that it was so easily contained is not as significant as if it was when it was in the U.S. mortgage market, or if in fact the Italians down the road have an issue. So it's reason for some joy, but I wouldn't go out and go buy in euros on the fact that everything's okay in Euroland. Look at this coming week's noteworthy events. I've thrown on Monday there, we have an E17 Eurogroup meeting. Throughout the week, we have a bunch of meetings. Different European agencies and different European leaders are getting together. There's always headline risk out there. It's worth noting, in particular, there's a meeting, I believe, on Tuesday between Monti and Merkel. That could be significant, but these politicians are pretty well versed in how to handle a press conference, so I shouldn't expect that there's going to be any significant news coming out. They're pretty well rehearsed, and they all say the same things. We're watching for any developments. It's important that we all help each other out. They're more feel-good photo ops, but again, you got to be on the lookout for somebody who says something they're not supposed to, which could move a market. We've got a bunch of rate decisions and Japanese and the U.S. tomorrow. We've got U.S. retail sales on Tuesday. The market is expecting positive results from the U.S. in general. The employment report that came out and the last few reports have come out pretty well. The market wants to be long dollars, and the market wants to believe in the United States. So that being said, unless there's a big surprise on the negative that retail sales come in particularly low, expect that the dollar in particular to keep gaining some sort of momentum. Again, we're still in a very tight range, which we'll discuss later when we look at some charts. But for now, the sentiment out there is U.S. is leading the expansion, the global economic recovery. I also throw on the Norwegian interest rate there. That has some particular interest for those of you who trade Euro, Norway, or Naki Staki, the Norway against the Swedish krona. Norway's been having a bout of inflation. Norway's heavily dependent on oil. They produce a lot of it, and as oil has been moving up into the higher hundreds, Norway has been seeing greater inflation and greater strength as well. It's used as a proxy for oil, and depending on what the statements has come out with the Norwegian interest rate announcement. Again, nobody expects any movement on the rate, but depending on how vociferously they say they're going to be looking at future price of oil and future rate of Norwegian inflation, there could be some meaningful movements in the Norway, particularly against the euro and the Staki. Keep an eye on that. We've also got the Swiss interest rate announcement. This could be particularly significant. Again, as we look at the Euro Swiss and the Swiss economic environment in general. Again, nobody expects any interest rate movement, but if a statement comes out talking about the Euro Swiss peg, which is currently at 120, any talk about them defending it at 120 or not defending it as vigorously as the market expects, or even bumping the peg up to 125, could have significant moves for the Euro and the Swiss and some of the other European countries and safe havens that are out there. Thursday we also get U.S. PPI and the regular PPI and the core PPI. These rates are starting to show a little bit of this inflation in this oil price. As you may or may not know, when they announce the PPIs, they announce one number without food and energy, which they call ex-food and energy. Again, I don't know how many people out there are living their lives without food and energy, but the governments of the world, for some reason, think it's significant to put it in there. As I'm sure we're all aware, as we all shop and we all drive cars, food and energy prices have been going up. So there seems to be a divergence between the regular PPI and that hyped up PPI without food and energy. So keep an eye on that. If that starts diverging a little bit more, it'll show that inflation's creeping into the world economy, and then governments are going to have to adjust their zero interest rate policy for that. And then on Friday, we also get Michigan consumer sentiment. Again, the sentiment here for now, it's almost like the market in the States here wants you to believe that things are going well, but when you talk to people on the street, there's still a bit of a backlash in terms of unemployment and housing. So we should get a decent number because things are trending better, as we saw the unemployment rates getting better, and that does help the market feel a little better about itself. As we said, we've got some major central banks talking interest rates this week. The BOJ, the Fed, the Norwegian Bank, and the S&B. Expect them to remain on hold. As we said before, there's been plenty of liquidity in the market, and we don't expect that anybody wants to rock the boat now. We want to see what the liquidity that's already in the market, what kind of effect it has on the global economy. And as has been the tenor for the last couple of weeks, focus likely to remain on Europe. The Greeks will be exchanging their bonds on Monday, and there could be some headline risk about that as well. Again, we're going to have exchange of payments on the CDSs. If people aren't happy about the rate at which the CDSs have to pay off, there could be some backlash. You know, it may not go as easily as everybody wants it to. And again, as I said before, we've got Eurogroup and ECOFIN meetings on Monday and Tuesday, and Monti and Merkel are meeting on Tuesday as well. Should not be significant. As I said before, these guys are very good, and gals, pardon me, are very good at holding press conferences and telling everybody that everything's okay. So expect that things should go as planned, and it should just be a nice feel-good press opportunity. China, as we know, has been a big part of the market lately. The only significant news that we've had about China recently is their trade data came in particularly weak over the weekend. On Saturday, Chinese released data and showed the Chinese deficit was larger than it's been in a very long time, and the degree of how large it was also pretty significant. This reporting period does take into account the Chinese New Year, so some people are poo-pooing it as saying that some of the adjustments made for Chinese New Year may have skewed some of the data, but there is no doubt. There's a lot of talk about the Chinese being not able to grow as much as they have been in the past, and speculation about soft landings and hard landings. The bottom line is we're starting to see a shift away from China being the catalyst for economic expansion, and that's moving away towards the U.S. And this is having a significant effect on some of the Asian-based partners, in particular the Aussie dollar, the Kiwi, the yen to a degree, but the yen has its own stimulus as well, and some of the smaller Indonesian, Malaysian, Filipino currencies. So, it's worth noting that keep an eye on the headlines as regards China, because there is a little spin away from China being the center of the growth universe now, and it is coming more to the United States. So, keep an eye on that. Different themes that we had, as we mentioned before, these two are held over from last week by popular demand, I guess. The Euro Swiss, we're still sitting at around 120.50 or so, and we haven't really budged much from there, which just shows you that the Swiss National Bank has either itself or has the market doing its work for them, keeping the Euro Swiss above that 120 peg area. It seems like you could, you wouldn't get much joy out of it, but if you can buy some Euro Swiss here at the 120, 30 to 50 range, it may actually be a good hold, and I'd keep an eye on like 119, 70, 75 as an area of stop loss in case something does go through. The other big event that we're talking about is Iran. It has ramifications for oil and gold as a safe haven. And President Obama last week came out hawkishly supporting Israel and their right to defend itself. He's toned those statements down a little bit in this week, but he has maintained that Israel does have the right to defend itself, and Israel has come out and said that with or without the U.S., if it feels threatened, it will act in its own interests. So those things are having some effect on the on gold and oil, and keep an eye on them. If something does happen in Iran, I would expect that the Swiss would have a very difficult time defending the peg at 120, just because the torrent of buyers of Swiss, or sellers of dollars, sellers of euros, and buyers of Swiss would pretty much overwhelm whatever it is that the Swiss have as ammunition to prop up that Euro Swiss. So that is worth keeping an eye on as well. And while that kind of talk with Iran has been muted a bit, Ahmadinejad was out over the weekend saying, you guys in the West can do whatever you want to us. We're going to be here. More sanctions, less sanctions. He's not one to look to smooth things over. So keep an eye on that as well. Let's go to the next slide. All right. Greece, as we said before, has had gotten over the first hurdle. The CDSs are kicked in, and the feeling is as well that Greece isn't necessarily out of the woods, because this is only the first hurdle, and the market seems to feel that down the road there will be some sort of event where the Greeks may actually go in default. And I put that little bullet point on the bottom on there just to make everybody understand that this last bailout was not necessarily a Greek bailout. What was actually being bailed out were the holders of Greek debt, which are almost overwhelmingly owned by European banks. So it's actually a European bank bailout. The Greek people themselves are in for a devil of a time. There's going to be tremendous austerity down the road. Austerity does not lead to growth, which if we look at that as a template for what's going to happen in the rest of Europe, the Italians are not in good shape. There's going to be austerity there. Then the Spanish, the Portuguese, the Irish, they're also going to be in for some austerity. So that being said, the sentiment out there is that the euro is going to be weak for a while. As great as the Germans are doing throughout this crisis, they need to sell to their European partners. And if their European partners are going to be embarking on an austerity program, that is not good for growth. So the pitch at this point, now that we have this euphoric first Greek hurdle out of the way, which they apparently bought euros on, it just doesn't look good down the road. If I were spinning it, I'd spin it as a lower euro melt down the road, and I would be very surprised if the euro, for any reason, really topped up above this initial 133.70 area and the recent highs at 134.80. So for now, I believe the melt is coming in euro. I just don't see where the good news is coming out of euro. And again, as we said before, there's been a shift in sentiment from Asia-centric growth to North American or United States type growth. As I say here, expect strength in the U.S. and economies that have significant dealing with the U.S. Expect that the Canada, Mexico, Brazil, and other U.S. partners that trade heavily with the U.S. to enjoy what is expected to be some robust economic growth coming out of the U.S. And look for the Aussie, the Kiwi yen, and some of the smaller Asian partners to start slipping a little as China falls back a little in the growth chain, as it were. So one sec. And again, this past week's U.S. employment data confirmed that the U.S. labor market's on track for a recovery. And again, the cyclical activity data have been rather mixed. With more robust job gains reduce the likelihood of QE3. There is some talk out there of another type of QE3 coming down the road, of a more sterilized QE3. But as we said before, with the other interest rate cuts, for now, it doesn't look like there's any need for it. Granted, if the U.S. did it at this point with the state of the current economic cycle globally, it doesn't look like it would be adding any significant inflation, but there's still no need for it now. I think Mr. Bernanke and the other central bankers around the world are loath to play another interest rate cut or a QE card unless they have to. And again, as we said, the Noki could be interesting. We get the rate cut keep an eye on the language as that could have some interesting effects on the euro and on the stocky as well. And again, we mentioned before different CPIs and PPIs out there. Look for the divergence there to tell you whether or not inflation's coming along. Again, ex-food and energy, I never understood it. I've been in the market for a while. It's almost like these government economists like to fool themselves into seeing what kind of utopian society they're in, where I don't know what planet they're on that doesn't have food or energy for its people at a significant cost. But there we have it. That's some of our talking points. And again, to illustrate some of what we're looking at, got some charts here. What you're looking at is a Euro-Swiss chart. Again, as we've been talking about the last couple of weeks, we've been sitting here nicely at this, this nice 120.50 area. I mean, it's significant in that it hasn't gone below there, and knowing that what we know, that 120 is an area of interest for the Swiss National Bank, clearly somebody likes it here. Again, we can't really seem to get above this 120.60 area in a meaningful way, again, with all the different crises that are going on around the world. But for now, it looks like whoever is holding it up in this 120.50 area is doing a good job. And, again, the only thing I could see down the road that could really put a crimp in what the Swiss are trying to accomplish would be if something happened with Iran, and if they were firing shots in the Straits of Hormuz and disrupting the oil supply. That could throw the global economy and this whole nice status quo that we have going on into a state of flux. So keep an eye on that. Other than that, I would nibble at staying a little long Euro-Swiss if you can get them in there at the lower end of this range. And again, watch that stop loss below 120. Next, take a look at Aussie CAD. As I mentioned before, we're seeing a bit of a spin away from Asia and China into the U.S. and you can manifest this, or you could see this more clearly on Aussie Canada. The Aussie and the Canada, as we mentioned before, have very similar economies. They're small. They don't run particularly large deficits. They're heavily commodity based, and they didn't really get sucked into the crisis of the last couple of years like some of the more major economies. That being said, they should trade on a more even basis between the two. And what we had seen at the end of last year, beginning of this year, was that when China was looking like they were going to lead the world higher, the Aussie leg of the Aussie Canada took off. We had gotten up to 107 and change. And that being said, the rising tide lifting all boats, the fact that China was going up, Asia as being one of its larger trading partners, that lifted up with it. As we're seeing and hearing about some of the weakness in China, we're seeing that that's now flipping. Canada, with its relationship with the U.S. being its largest partner, is now seeing some of the strength. That for the sole reason that Canada will enjoy on a tangential basis the growth that's coming out of the U.S. So what we're seeing in the Aussie Canada is, if you could visualize it, China up, Aussie up on the Aussie Canada trade. China down, Aussie down. Where's the next part? The U.S. is the one that's going to be taking the lead in the economic recovery. So the Canada is that. In a perfect world, if China was slipping, and you would expect like Euro Aussie, and if the Euro didn't have as much trouble as it's having now, and they expected Europe to lead the way, you would expect the Euro leg to take up some of the slack. So again, when you look at some of these different, not funky, but some of the off the run crosses, you have to pay attention to what the fundamental economic underpinnings are of those particular areas. As they move, these currencies will move with it. Sometimes the action isn't necessarily in the straight euro dollar or euro sterling or euro Swiss. If you go off the run on some of these Aussie Canada or Kiwi yen or some of these other type trades, you can get a nice move on them every now and again. Let me take a little break here and see if anybody has any questions. If anybody is interested in any more depth of anything I said, feel free to fire a question over. I'd be happy to address any questions anybody might have. All right. I'll take that as license to move on. We've got here is a picture of dollar yen. Dollar yen, as you can see, I'll actually change that chart a little. Okay, this is, as you can see it, this is almost like a daily chart for a year. No studies or anything on it, but you could see that we've had a pretty interesting move down, and the question is, what is this move all about? Well, the Japanese themselves have added liquidity. They pretty much, their talk has done what their purchases of dollars against the yen could not do. As we know, in the last couple of years, they made a couple of moves to buy dollars to help their economy out by weakening the value of the yen. Their exporters are having a very difficult time making profits just because the currency has strengthened so much. Between some of the safe haven return of funds after the earthquake and the global safe havenness of the yen being that it's as far away from Europe as you could get, so people were moving there as well. This was not particularly helping the Japanese, and now that we're a year on in the post the earthquake, it looks like they're not going to be, the economy is going to remain in the doldrums. There's also other significant data that the U.S. has said they're not going to be cutting rates anymore. So that's put a little bid on the dollar side. It's sort of, we're moving away from the safe havenness because the feeling is that the U.S. is coming out of its negativity. And that being said, there's no reason to park yourself in low yielding Japanese, low growth yen area. You're much better off, for lack of a better phrase, taking a shot in the U.S. than you are in Japan. So we've seen a nice move out there in the last couple of weeks, and most of the market pundits that I've been talking to, the bank research houses, are saying that they expect 82 to 86 to be the range, and if you'll notice for last year, that has been the range. So what else can we say about the yen? There's not much about the yen, but I'd like to talk about interest rates in general. We spoke a little about Aussie Canada before as well. The Canadians may be looking to raise their interest rates. They're not as they're having a very good economic time as well, so they're not necessarily on this cutting rates. And the simple formula in currency trading is the higher the interest rate, the better the opportunity to make money in a currency. That being said, as the U.S. looks to stop its quantitative easing and cutting rates, particularly as relates to the yen, the U.S. we expect to see a higher dollar yen just on that basis alone. It follows through also to gold as well. The question with gold is why is gold in the last couple of years had such a tremendous run up? It doesn't do anything, it sits there. Well, with global interest rates at or near zero, and with as much certainty as we've had in the global economic world, the problems with Iran, the problems with Greece, China with its economic recovery, you're not giving anything up by holding gold. If gold is going to pay you 0% or dollars are going to pay you 0%, in light of all the trouble out there, why not just sit on gold? But as interest rates start to go higher or start to have the impression that they're not going to be going much lower, that's where the safe havenness comes out. The U.S. Doesn't need a safe haven. The U.S. is going to be strong. So why am I sitting in gold? It pays, 20 basis points at max. Same thing with the yen. There's nothing going on. Even if you're a Japanese investor who's brought money back home because of all these crises, the U.S. is not going to be cutting rates anytime soon. Granted, they've said that they're not going to be raising rates anytime soon, but there's no reason to park it in these safe havens. You know, you can get out of gold, you can get out of yen, you can even get out of Swiss to a degree. You know, again, Iran situation on the sidelines. So there's a movement that the market is starting to dip a toe and get more comfortable coming out of these safe haven scenarios. So that's some of the things you have to look at. You know, it's not like you just say, oh, there's turmoil, I'm going to buy gold. You know, why are they buying gold? You know, why, you know, at 1700 does the economies of Australia and Canada do well? It's not just because gold. It's not like they're sitting on inventories of gold that's going to get higher. But what the actual underlying economic footing is in gold in particular, there's a cost to mine gold. If it's $500, $600, $700 an ounce, as that price goes higher, it actually it's more beneficial to the company to go out and get the gold out of the ground. What that means is companies expand, they hire more people, so thereby government's taking more taxes, there's more unemployment. It's the whole bottom-up effect of gold. It's not just that gold's going higher, so the country is doing better. You know, it's not like the gold's sitting there on an exchange buying and selling gold. It's the whole economic effect of a higher price of gold. It's now more feasible to go out and get some of the more high-cost gold to get. So that's why how some of these effects on commodities have effects on the underlying currencies. So that's just a little lesson there about the whole macroeconomic view of supply and demand. And that being said, on gold, let me give you a little look of gold, because we are starting to see a little, all right, there's a little pressure. We had gotten up, this is the end of last year, but again, we reached recent highs here at 1780 or so, and we've had some, this line here coincides with some good data out of the U.S., and the fact that, again, some of these crises are over. You know, the Greek bailout, again, nothing to do with Greece, more to do with European banks and just a settling of the world economic feeling in general. So that being said, if we're not going to be cutting interest rates, nobody needs to hold on to gold as much. We're sitting right on the precipice of some interesting levels here. Again, this 1670 area could be significant. If we get a crack through that, we could get a nice move back down to 1600, and again, below 1600, we take a run at last year's lows, the end of the year lows at 1550-ish. And again, like as we've seen in this move from 1775 down to 1720, you know, you could have a $50 day, you know, depending on what's going on. And, you know, there's an old saying in the market, when everybody tries to go through the door at once, they take out the wall. So, you know, have your stops in place, and hopefully there won't be too many gaps along the way, and you should be okay, which is good advice in every currency pair and every even equities or whatever you're trading. Again, I'll open the floor now. Any questions about any particular currencies or any commodities? If I have an opinion on that, I'd be happy to share it with you. All right, Sam. Yeah. The more actively traded pair is CAD Swiss, not Swiss CAD. And again, my feeling for now is you want to be long the Canada. Again, as we get through some of the economic events, notwithstanding the Iranian crisis, I think you'd be better off actually in CAD yen, because I think that's going to continue moving higher. You know, Canada against Aussie CAD, Kiwi CAD. Those, as I said before, as Asia moves a little bit off the front plate, the Canada's going to do a bit better. So I would take a look at that. And we had a question about silver. Silver again has not shared in the run up that gold has had recently, because it is a quasi-industrial metal. And as the economies of the world start picking up a little steam, if in fact that happens, expect that it'll at least maintain where it is now. Again, for the interim move, 28's been the low. We're sitting at 33.5 now. I wouldn't expect it to, even if gold does test its 1600 or 1550 lows, it shouldn't go too far below that. So I would I'm a better owner of silver, although I think at some point the luster is going to be coming off the metals in general as a place to keep your money. It just doesn't pay. I mean, there's no benefits to it. It really is just a place to park yourself. And like I said, they're particularly illiquid markets. I mean, look at this move here from on this move lower. We went from 39.70, down to 31. That's almost a 20% move in a day. So when they're trying to get out, they're going to get out. I mean, look at some of these lines. When the moves come, they're violent, and again, that's because it's a particularly thin market in the metals. So have your stops in the right place and hope you get done, because it's very tricky. That's why, to some degree, some of the players that are in the Norway as a proxy for oil, there's probably a little bit more depth in the currency end of that than in the oil, because the oil traders, most of it goes on an exchange, and those exchange traders are notorious for pulling their bids or offers when you need them the most. So the currency market's a lot more liquid than some of these futures and commodity markets. So if you could find a proxy for some of these, and for now the euro has been acting as a proxy for gold. It's been highly correlated as of late again. So if the euro starts going lower, you may actually see gold going lower with it. So keep an eye on those. Is there a currency that uses more silver? Would you trade a currency against silver? Well, right now, I mean, you can. They're not readily available in most places. I know Forex.com traded gold against Swiss, yen, euro, sterling, and Aussie. You could create your own, but again, that would leave you somewhat open to some of these gaps as well. Again, for the last couple of months, the euro has had a decent enough proxy with gold, and to a lesser degree silver. But it's hard. You could try and get them. You'd be better off if you could find. There are some of the firms that actually trade options, foreign exchange options. I know Alpari was doing it for a while, and some of them had gold and silver on it as well. If you're offshore, and a lot of these currencies that you expect to gap, sometimes you're a lot better off putting on a option trade than you are a straight currency trade. That for the sole reason, if you look at this area here, right, nice big gap here. If you had an order to sell, let's say here at 36.50, and it didn't get done, they could say our next price that we saw was down at 33, and they could skid you for $3 on that. If you had an option in here at 36 and change, you get that price. So in some of these more volatile markets, again, the same was true in euro. If you had a stop loss at a bank, back when we cratered down to 126 and change, and we gapped a big figure or so, you may not be able to get that fill. But if you had the option in, you could get that fill. So it may be, if you're looking to do some of the more toxic stuff, or if you personally think you're going to see a violent move, an option may be a way to go. And there are options on exchanges, and there are options, Chicago has options, Life in London has options, and there are some players in the online FX universe that show option prices as well. The binary market has options as well, which is new, and I'd counsel you against getting involved in binary options at this point. It's a new market, and the few companies I've seen that have something out there, the costs are a little expensive, so I would stay away from that for now. But Chicago or Life if you're looking to do some option stuff. And again, I only counsel you to look at it if you're expecting a real violent move one way or the other. Other than that, it could just be, a waste of the premium. But that's for you to decide. Again, like we said in the disclaimer, definitely learn all there is to learn about the given product and make sure you're doing it with the right counterparty at the right time. It's your money, protect it for yourself. Nobody's going to be a better advocate for you and your money than you are. Anybody else have any questions? Or in case I missed anybody, give me a sec. I'm going to toggle back just to make sure. All right. I think we're good. Again, let me just give you my the little story coming up, and then we'll wrap up here as it's getting a little late. Again, my personal bias at this point is stay long the Canada, stay long the U.S. dollar, some of the other North American or the currencies that have access or exposure to the U.S. market. Again, for now, sentiment seems to be that the U.S. is going to lead the recovery. As far as Europe and the euro goes, for now, the tone is somewhat negative for Europe. We've gotten through this initial Greek hurdle. Still a lot of talk out there of future default down the road for Greece. That being said, we're done with Greece. Now we have to take a look at Italy, Spain, Portugal, and Ireland. And there's nothing. Where's the good news? Where's the positive surprise from that? It's going to be a slow growth environment ahead for Europe with all the austerity programs and all of these the peripheral current countries, as they say, and as relates to the Greek thing as well. There's austerity coming up, and who knows if there's going to be a smooth transition for these CDSs. The CDS market is it's passed its first test in a relatively small market, but the Italians have a lot more mortgages and a lot more bonds out there that they're looking to that there's going to be CDSs on, and the counterparties may not be as happy to play ball as they were with Greece. And that's it. Right now, it looks like, will the weak euro promote exports to the U.S.? Well, the problem with the weak euro promoting exports to the U.S. is, the currency doesn't export. It's the countries within the Eurozone that are going to be looking to export. That being said, if the Greeks are going to be cutting pension, salary, employment, they're not going to be in a position to produce things to actually sell. The same things for the Italian, Spanish, Portuguese, and Irish. If they're going to be cutting benefits, that means they're going to be cutting employment. They're not going to be producing as much. So, austerity, while it sounds good and it sounds like you're taking care of your own house, it's not a savior, because these countries or these industries within these countries are going to be producing less. So on the one hand, yes, under ideal circumstances, a lower currency means you will export more. But if your currency is low because you're in the midst of an austerity program, then you're not going to be producing things to sell. So it's a tough environment ahead. Here in the U.S., there's not much austerity. People are starting to produce. Okay, the country will it promote Chinese growth then? Well, the Chinese aren't embarking on a austerity program. The Chinese, again, they just said this week, because of their weak trade balance, they're going to look to manage their currency by they're going to look to manage their economy by interest rate moves and currency moves. So they're still going to be producing. They don't have the need. The Chinese have tons of cash. At this point, they're not in the same type of crisis that Europe is. Europe has a banking crisis and they have a sovereign crisis. The Chinese have an economic crisis. They could still produce things and they could still sell to some of these lower cost places. What could actually happen down the road is the Chinese, or to a lesser degree the Japanese, who are starting to help the Chinese, produce more advanced goods, they could capture a larger piece of the European pie. The Europeans aren't going to be manufacturing as much. The Chinese can come in and manufacture and steal even more economic activity away from Europe. So it's not a question of, it's a question of where you are in the cycle. The Chinese are still going to be producing. That's what they do. That's what they know. So, and they still have tons of cash. They're just looking at a slowing now. And again, it's just a matter of them retooling. The Europeans have a systemic issue where that they're just, everything about their economies are in bad shape. Employment, pensions, governments, everybody has the problem. So Chinese wages are increasing. Europeans, on the other hand, are limiting wages. Well, true. And that being said, even if the Chinese just stay where they are, the Europeans are going to be reducing. They're going to be reducing wages. They're going to be reducing. There's talk in Greece that part of the austerity program is cutting pensions by 20%. Now, if you expect it to be retiring with $100,000 and you're getting 80, that's going to put a crimp in what you're doing. And again, that's just the first shot. If this thing lingers on, there's probably going to be more cuts down the road. So that's that. And right now, to give you an idea, most of what I've been reading lately, politicians now are more concerned about economic growth than inflation. So, if there's going to be some issues down the road here, if they do start cutting rates again, the effect down the road is just going to be more and more inflation, and that inflation is going to erode people's wealth even more, which is going to, hurt economic growth down the road, even as they can get out of it. That's agreed, Fernando. I mean, that's, it's a global phenomenon, I don't want to get biblical on everybody, but you had your 7 fat years. Now it looks like we're in our 7 lean years. So it's, we've probably got a few more years to go till we get out of that. But, that's my story for this week. I hope I gave you some thoughts that actually help you formulate some good decisions for the coming week. Let me tell you a little bit about who I am. We are Forexfolio. We're a team of Forex specialists who have diverse experience in education, trading, and our aim is to help anywhere from novice to experienced traders understand the markets, understand their dealing counterparties. We have different programs that we do. We send out trading signals. We have virtual desktops. We have an EA service where we're constantly tweaking EAs to take advantage of different scenarios that are ongoing in the market, different correlations that are going on in the market. We work with most of the top brokers. If we don't work with the broker of your choice, give us a call. I'm sure we have a relationship. We'd be happy to help you out with any problems you might be having. Alpari is our preferred broker at this time. They're very aggressive, and we like the way they handle their customers. We have dedicated people at Alpari to help with our people. And how can you get in touch with Forexfolio if you're interested in getting involved? You could reach us by phone, 1-800-756-7509. You could email me at paul.spirgel@forexfolio.com. Check out our website, www.forexfolio.com. You could Skype us. We're on Facebook. We tweet regularly. Feel free to contact us if you have any questions. And we're here to help. we could all use a little help going on now and again. Feel free to reach out to me if you'd like. We have another email, tradingsignals@forexfolio.com. And again, we strive to reach back to whoever contacts us within 24 hours. And feel free to contact us. And thank you for attending. And if you have any questions, comments, or critiques, please drop me an email. If there's any topics that you want to talk about, I'm more than happy to. Keep well, and thank you for joining me.